Most people think financial markets are fair. Messy, sure, but fair. The prices move because of supply and demand. The regulators keep the worst behavior in check, and that if something is too abusive, someone steps in. The Jane Street Indian option scandal changes that belief. Not because Jane Street broke the law in a traditional sense, but because it revealed just how fragile and poorly designed parts of the options market really are. This isn't a story about one firm being evil. It's a story about incentives, loopholes, and systems that quietly allowed one of the most notorious trading firms on earth to dominate an entire market. Jane Street isn't a hedge fund in the way most people imagine. They don't run flashy strategies, they don't pitch to retail investors, they don't make bold predictions on CNBC. Jane Street is a quantitative market-making firm. Their job is to provide liquidity, quote prices on both sides of a trade, profit from tiny efficiencies at massive scales. They operate in stock, ETF, bonds, futures, and especially options. They are very, very good at it. Globally, Jane Street handles trillions of dollars in trading volume every year. They employ elite mathematicians, physicists, and engineers. Their edge isn't luck, it's structure, speed, and statistical domination. India's equity derivatives market grew fast. Too fast. Retail participation exploded, weekly index options became widely popular, and liquidity surged to $5 trillion at its highest. With that in perspective, India was trading at 422 to 1 cash ratio, while United States was 9 to 1. In short, the market was dominated by short-dated options, emotional traders, and mechanical hedging flows. That's not immoral, it's just exploitable, and Jane Street noticed it. Let's be very clear here. Jane Street did not leak information, front-run illegal orders, or hijack systems. What they did was far more subtle and far more devastating. They understood that the option pricing in India was structurally misaligned. Specifically, retail traders overwhelmingly sold volatility, dealers hedged mechanically, and index movements near expiration were predictable once flows were understood. Jane Street used massive balance sheets and advanced models to absorb retail flow, control liquidity near critical strikes, exploit expiration day dynamics, and profit from gamma and vega imbalances. One of the trades they executed was on January 17th of 2024 on Nifty Bank, which was seeing a market decline at opening. Jane Street used their massive balance to buy stocks in the bank to make it look like it was stable, lowering the price of the puts. They then bought up massive amounts of puts at a low price before dumping their shares in Nifty, making the stock drop sharply. In return, raising the price of puts they had previously bought, which would outweigh their losses from selling the stock, returning a profit in the end. Eventually, the numbers became impossible to ignore. Jane Street reportedly generated enormous consistent profits from Indian index options, roughly $2.3 billion in profits. Jane Street was originally barred from trading, but after an initial deposit of $567 million into an escrow account monitored by the SEBI, they were allowed to resume trading, but most recently a spokesperson for the company said they haven't been trading in the Indian stock market.